Hello, and welcome to Team Andrew's team analysis for years 7 and 8. Our team has worked efficiently and effectively, collaborating on the best decisions for our company and products. I'm Kennedy Mateo. I'm head of production, finance, and TQM initiatives. The main goals include running a yearly production schedule, forecasting our finances, and finding ways to reduce our material, labor, and administrative costs. The remaining of our SWOT analysis will highlight our other areas of business, our overall business for the past 8 years, and where we stand among our competitors.
Hi, my name is Jordan Haywood and I'm in charge of marketing for Team Andrews. My main focuses are product pricing, sales and promotion budget, and unit sales forecasting. I use each segment's analysis from the Capstone Courier to set prices. The percentage of importance assists me with this. By increasing the spend on sales and promotion budgets, I allow each of our products to hold high customer awareness levels. Lastly, by using the potential market shares and units page and upcoming year segment growth rates from the Capstone Courier, I'm able to predict unit sales in the next year. In addition to marketing, I also assist with human resources. Specifically, I calculate the necessary spend for recruiting and training.
Hi, my name is Tyler Primer, and I am in charge of research and development for Team Andrews in the Capstone. For the R&D, I look at our product lifestyle, develop new products to introduce to the market, and monitor customer expectations. These are reported in the Industry Conditions Report and the segment analysis pages of the Capstone Courier. As part of R&D, all new products require capacity and automation, which must be purchased by the production department 1 year before the product's release. R&D and production must work responsibly together when new products are introduced. R&D also has to work with marketing. Marketing can't sell a product if R&D invents or revises something that no one wants. Together, the departments can identify and target customer demands for product positioning and mean time before failure for each sensor. For Team Andrews' R&D strategy, we want to first meet customer criteria. Then we want to shift all current products for placement within the perceptual map circles, produce new products in our main focus points, which are high-end, performance, and size segments. We want to reposition the products towards the long-term perspective of Team Andrews and provide quality sensors to all the markets available in the most efficient method. Team Andrews wants to produce a competitive edge by incorporating attributes and features that set our company and products and services apart from our competitors in ways that buyers consider valuable. Successful differentiation allows Team Andrews to 1. Command a premium price for our products, 2. Increase unit sales because additional buyers are won over by the differentiating features, and 3. We want to gain buyer loyalty to its brand because some buyers are strongly attracted to the differentiating features and bond with the company and our products in this way.
In order to generate the most sales, we must have competitive prices. The Capstone Courier provides us with customer buying criteria. This criteria contains a range and a percentage of importance to consumers. Staying within this range, especially when price is of high importance to consumers, is important. We want our consumers to be aware of our products, so spending on promotion, for example, TV and internet advertisements, is essential to the overall success of the company. The Capstone Courier also provides us with a potential market share page, which is used to predict unit sales. We pay close attention to this in order to accurately predict unit sales in the next year so that we can create just the right amount of products to avoid a surplus or shortage.
At the end of year 8, Andrew's low segment product, Acre, continued on as our best-selling product. We sold 2,498 units at the price of $21.50 with a contribution margin of 54%. Additionally, Acre had the lowest material and labor costs compared to the rest of our products. The material cost came to $4.60 and the labor cost stood at $5.19. In our year 8 forecast and scheduling, our team decided to increase automation levels to decrease labor costs. Acre had the highest automation level of 8. ACE, our performance segment product, had the lowest automation level of 4, which in turn also incurred the most expensive material and labor costs. During years 7 and 8, we started to see the payoff of keeping a lower automation with ACE. Our goal was to be a market driver and high performer in this segment. Overall, we kept inventory levels a minimum. We held enough in our inventory to not stock out and meet customer needs.
We want to obtain top talent, so it is important to spend some funds on recruiting. By increasing our recruiting spend each month, we are recruiting high caliber workers and keeping the employee turnover rate low. Next, we allowed employees to take 80 hours of training sessions each year. This allowed a higher productivity index, and while workers are away training, another worker fills their position, so work is still being completed.
The company saw a net change in cash position of $26,586 at the end of year 8. For years 7 and 8, our strategy was to increase our cash and profits and decrease the amount of long-term loans we were taking out. We want to strengthen our financial position and lessen our liabilities. We found that our proactive approach of taking limited long-term loans out started to pay off. Our company had the second lowest amount of long-term debt and one of the only companies with no current debt. Our long-term debt currently poses a liability of $49,500. In the future years to come, our company would have taken initiatives to decrease that amount by even more. For our final years, Andrews monitored and reviewed all costs of the company. We worked to lessen or eliminate any costs that weren't necessary to the success of the company or were no longer needed. For example, since we increased our automation levels, we decreased our recruiting and training initiatives. Although recruiting and training are still valued, we felt we didn't need that much of or as high of a budget to continue. The TQM initiatives were implemented to reduce material and labor costs and to lower vendor and channel support system costs. In year 7, we continued to take steps of lowering material and administrative costs by implementing the vendor just-in-time inventory program. The company invested $1.5 million in the program to start with. Additionally, we invested another $1.5 million to the channel support system to increase the effectiveness of the sales budget and demand. In year 8, we circled back to investing a final $1 million into the CPI system program. The CPI program reduced material costs and to a degree lessened labor costs. Andrews Company is the fourth largest in the sensor market segment. We hold 7.28% of the market share with room for continued growth. Years 7 and 8 brought a total of $106,093,856 in sales and a cumulative profit of $37,495,168. Our goal is to keep a contribution margin over 30%, and we're pleased to say we've obtained a contribution margin of 45.1%. Overall, we were able to issue stock and use a limited dollar amount of long-term loans to grow our business and see positive financial growth.
In year 7, Team Andrews had sales of over $147 million, which was pretty average compared to other years. During the CAPSIM, Andrews profited over $34 million and maintained a contribution margin of 35.2% in year 7. We also had an overall market share of 11.65%, which was fourth amongst all competitors. We did fairly well with stockouts in Able, which was our traditional segment, and Acre, which was our low end segment. Agape and Ace nearly stocked out in year 7, which means we did a pretty good job of forecasting for this year. Aft, which was our another performance segment, struggled in year 7 because it was undergoing R&D and wouldn't be available to the market until 2028. Team Andrews had overall sales of $106 million. We profited $37 million and maintained a contribution margin of 45.6%, which was the highest it's been over the 8 rounds during the cap sim. And this year, we had an overall market share of 7.28%. And our 2 best segments for year 8 were Acre, which is our low-end segment with nearly 2,500 units sold, and Able, a traditional segment with 969 units sold. Atom, our high-end segment, did well in year 8 with a stock out and 277 units sold. I think it could have done better and sold more if we forecasted the number of units and inventory better.
Andrews has proved to be able to adapt to the evolving market and modify our strategy weaknesses to meet our overall company goals. Our team has found that by collaborating on ways to decrease costs and increase efficiency and effectiveness, we've been able to meet our goals and improve our financial and marketplace stance. We believe that working together and cross-training is one of the best ways to build a business and keep a continuous flow of ideas and strong strategies. The company is a competitive contributor in the sensor market. Compared to our competitors, we have been able to maintain competitive prices and produce high-quality products. After every year, we review the yearly reports and produce new ways to meet customer expectations. Our company is prided on our customer awareness and our loyalty to our consumers. From our yearly report examinations, we are able to be a leader in product innovation. Our R&D department is diligent on continuous product improvements for our products to our customers.
We lowered our recruiting and training spend to allocate some funds towards other objectives. This caused our employee turnover rate to shoot up to 9.4%. Next, we had a lot of excess inventory after year 8. Specifically, Agape, our size product, only sold 192 units, leaving the company with an oversupply of 1,000 units. The only product that stocked out in year 8 was Atom, which only sold 277 units. Our performance product, Aft, did not sell any units. Consumers preferred competitors' performance products who sold at a much lower price. Lastly, our product in the size segment, Agape, had a contribution margin of 0% after year 8. Adjusting the price and budget spend should correct this issue in the future. Andrews' company did not make any specific ethical decisions in year 7 or 8, but the company was within the normal range for all ethical aspects. Andrews' company believes in catering to our consumers, so we always put them first in everything we do.
Team Andrews was able to generate over $1 billion in sales over the last 8 years, as we wanted to focus more on specific segments like our high-end performance and size sensors. Our top sellers every year came from Able and Acre. Instead of creating a new performance sensor like Ace in year 4, Team Andrews could have done more R&D on other products to help boost sales and create sensors in other categories that perform better. However, Team Andrews did create a niche market with the performance segment, and even though there were low numbers in sales for the entire industry, Ace did perform well enough to help contribute to total profits and remain a contribution margin above 30% for every round.
Team Andrews strives to be profitable after each year. During the course of year 8, the company generated $106 million in sales, driving a cumulative profit of $37.5 million. Beginning at the start of the company, we decided to turn our focus towards our high-end and performance products, but every year our top performers were our traditional and low-end products. Due to changes in consumers' needs and competitors, we had a lot of excess inventory at the end of year 8. With continued cross-collaboration between departments, Andrew's company will remain successful and profitable in the future.